Thank you, Mike. My name is Trilliam Jeong. I'm the co-founder and CEO of WealthBlock. WealthBlock is a fintech firm based in Chicago. We build cloud-based white label capital raising platforms for private deals. On one hand, the platform streamlines the entire capital raising process from online offer creation, investor outreach, to investor onboarding, and investment processing all in one place. On the other hand, it leverages behavior data and automated marketing to target and retarget high probability investors. As a result, our clients' fundraising productivity usually 5 to 10x on average. So today's topic is modern capital raising shaped by technology arms race. We will cover a little bit of what I have observed in the marketplace. This is not meant to be comprehensive. Rather, I'd like to cover a few tech trends in private capital raising space and the framework of trust-based investment sales. With this framework, you will be able to anticipate where the innovation is going and what may or may not work. Let's start. To survive in today's capital market, high efficiency is a must, and that's pretty self-evident. We have seen many signs of this already. For one, in public trading space, commission rate has gone to zero, all the way from over $100 a trade before the deregulation of brokerage commissions back in 1975. Of course, it's well known that zero commission trend was made popular by the young tech startup Robinhood out of Silicon Valley. But does anyone know that way before Robinhood, there was also another West Coast firm who pioneered discounted brokerage and started this trend of commission reduction. They were first able to reduce the rate from over $100 a trade to below $60 a trade and continued to reduce from there. Well, this firm I'm talking about is Charles Schwab Corporation. Today's leader in the discounted brokerage space was also a startup back in the 70s. And their secret? Technology. To achieve the efficiency they needed to charge a deep discounted price, they actually built their own trade processing system more than 2 years before IBM even introduced a prototype system for brokers. Another well-known example is in investment advisory space. While conventional registered investment advisors are charging over 1% of asset under management per year, robo-advisors have pushed that rate to less than 25 basis points. Now, all of these efficiency improvements is a result of technology. So far, fintech has been mostly used to improve back-end operational efficiency. As we can see in the following areas, in compliance, we have a long list of new vendors providing online KYC, AML, and accreditation checks. In payment, we have Dwolla for white label ACH processing, Plaid for banking connection. In fund admin, we have software vendors like FundRails and FundCount develop software directly for venture capital firms, private equity firms, as well as fund administrators. As e-signature and the data room receive the legal and compliance approval, they become the new standard of doing business. In cap table management space, Partner is the dominant force that have made a good-to-have product necessary. Finally, in the investment management space, the solutions like Juniper Square and the EVAS are pushing to further improve investment management efficiency with a front-end integration on top of their back-end processing. Now, fintech has mostly focused on the back-end. What about the front-end? Well, it's primarily lacking from an investment sales and marketing standpoint. But why? Number one reason is the investment sales market is considered too small by the number of users. So unlike consumer market in the millions of users, and then we're certainly only looking at thousands, if not tens of thousands of users by today's standard. Second, the investment sales professionals are usually slow to adopt new technology. Conventionally, investment sales rely on relationship and high-touch approach. The ones with existing relationships tend to be less tech-savvy and more resistant to adapting new technology. Of course, COVID-19 changed all of that. The third is the problem of sales and marketing is very often challenging. For example, a lot of human psychology and behavior actually, rather than the pure workflow functionalities, consist of most of the problems. So it's not really a place where you can easily plug in A and you can reliably get a B from another end. Instead, there are many variables in between that makes the sales process fluid and unpredictable. But that's precisely where the opportunity is if you can overcome the hurdle while others can't. At least from the marketplace, we can already see that both the incumbents and the newcomers have already recognized the opportunity. So the incumbents, the Commonwealth, the Stonehenge, LPL, have invested millions of dollars in multi-year projects to actually develop their own proprietary platforms to improve their broker-dealer operating efficiency. And investment bank-backed tech startups like iCapital, Case are trying to disintermediate private investment sales. Third, you have the new disruptors like the Start Engine, WeFounder, and the YouStream are trying to take private investments directly to the retail customers. Well, the underlying thesis of this trend is that, one, there is an increasing demand for democratization of private investments. So retail investors want more access to this space. And two, there's an increasing demand for retailization of technology. Unlike institutional investors who tend to be more data-driven and function-driven, so as long as you give them something that's functional, like a Bloomberg terminal, they don't care much about how it looks or feels. On the other hand, retail investors are so used to retail-oriented e-commerce-like intuitive designs. They expect the same intuitive and frictionless experiences when it comes to investment. And that explains the tremendous success of Robinhood with more than 10 million first-time DIY stock investors. With an intuitive design, you don't need a manual. You don't need much training. You don't need guide from experts. You feel empowered. Therefore, you take more actions and engage more. Now, how can fintech really improve the investment sales? And of course, besides the Silicon Valley's obsession to reduce friction, which is important, but there's certainly more to it. Well, to understand that, let's take a look at our target market. So at any given time, you have about 3% ready buyers for your product or service, and about 7% that's open to buying, and 30% interested but timing's off. Then you have 30% not interested and 30% will not take it even if it's free. So now it's pretty common for the majority of the effort to focus on the 3%. And that's what many of the startup founders or real estate sponsors and first-time VCP founders do. On the surface, it makes logical sense, as these investment offers usually have a time limit. Either investors buy in right now or never. However, the most successful mature firms have a very different approach. Think Blackstone, KKR, and BlackRock. They have dedicated marketing and sales teams that is always raising. With their continuous marketing effort, they're able to target the 40% of the target market instead of 3%. And that's already more than 10 times the size of the original target. Of course, there are even more added benefits and necessity in taking this approach, which I will cover shortly. So what are the areas that fintech can really help? Number one, we can increase the size of the pie. So if the total size of the pie increases, and then every piece of it also increases. This is where technology can help. So instead of just reaching out to tens of tens of people, now you can reach out to tens, if not thousands, if not millions of people by sending out mass personalized email to invite a large number of investors to an online data room or portal. And two, correctly and efficiently identify the 40%, such as using behavioral data to measure interest. Action speaks louder than words, and our behavior certainly tells more truth than our words. Therefore, technology can help us actually collect and measure behavioral data in real time with high accuracy to help us accurately target the 40%. Three, systematically nurture the 40%, such as routinely following up with value-adding content. So let's say you don't have a dedicated team to nurture 40%. How do you even compete? Well, technology can easily help you 10x, if not 100x your productivity. But the process is extremely important and necessary because you need to build trust and to stand out from the mass all at the same time. To stand out, other than being controversial or risque, which is not common in business communication, the best alternative is actually through repetition of value-adding contact. Through this repeated value-adding contact, you also build trust, which is crucial in investment sales, which I will cover in the next slide. And number four, close whenever investors are ready, such as enabling online investment processing. Our actions are triggered by emotions rather than rationale. Emotions come in waves, and they don't run on our own timetable. Technology allows us to be available to accept the investor's actions 24/7. Let's say if someone had a glass of wine at 1 o'clock in the morning and wanted to invest, you want to be ready. So nurturing is especially important in investment sales because more trust is required. Now, why is that? Because investment sales involves higher risks from the investor standpoint. Number one, the amount is usually large, so potential loss is large. Therefore, risk is higher. Number two, feedback loop is usually long, and it usually takes years to validate the quality of the investments. Unlike the e-commerce, you place an order on Amazon, 2 days later, you already know that you have made a mistake or not. But investment, very often not so. Therefore, the longer term of uncertainty means a higher risk the investor must undertake. Three, most of the people don't have the expertise. Even the professionals have a hard time to actually assess the quality at all times because different type of investments, especially private investments, involve different type of structure, conditions, operators. And the quality, by the very nature of it, is intangible, and it requires expertise to actually assess. So all in all, investors are facing much higher risks during this private investment process. And from a sales standpoint, investment sales professionals need to help investors overcome these risks to make a purchase decision. At the end of the day, whoever can help their investors overcome these can make better sales. And how do we do that? Through building trust. As we mentioned before, in business communication, one of the most effective ways of building trust is through repetition of value-adding activities. Now, the key is really in integrating all these pieces together so that data intelligence actually flows. Now, let's put all the pieces together to see how that flows. And the viable tech solution that can truly help us are the ones who can integrate all those pieces efficiently. To start, that you need a mechanism to be able to send out, let's say, outreach to mass number of people. So emails is a pretty common way of doing that. But since emails become so abundant almost everywhere, making it scalable and highly personalized is key. And from that personalized email, you can collect the behavior data, which feed into the second piece, which is to identify the 40%, as I mentioned, using behavior data and a quantitative measurement that you can do a much better job with high accuracy. Then in turn, you collect the data from the interaction about the 40% to retarget and to nurture, to launch a nurturing campaign. Throughout the nurturing campaign, the engagement data will inform you that if they are ready or not at any given time. When they are ready, that you should have a system ready to close automatically. So that will conclude my today's presentation. Let's take a look at the poll, and back to you.